So first of all, before I start, I know Phil is not on the meeting today, but I just wanted to thank Phil for facilitating the meeting today. And I hope you find the next 30 minutes beneficial and informative. And as I said, we'll touch base with you individually at the end of the meeting or in the coming days for those of you that want to get a more detailed breakdown of your main scheme benefits. So what I wanted to do is, what I wanted to do just before we get into the presentation, for those of you that haven't met with either myself or you're not familiar with Irish Pensions and Finance, first to introduce myself, then to tell you a little bit about the company, who Irish Pensions and Finance are and the services that we provide for CAMHS, and then just to very briefly go through the agenda for the talk today. So just a little bit about me. So as I said, Ruth Waters is my name. I'm a qualified financial advisor and retirement planning advisor for Irish Pensions and Finance, and I'm with the company 14 years. The area that I specialise in is the main superannuation pension scheme and options that are available to civil and public sector staff if they have any concerns around their main scheme benefits, because your pension is treated quite differently to that of private sector staff. So it's just to see, look, what options are available to you as civil and public servants, okay? So very briefly, the agenda for today is to go through really, I suppose, what are the main reasons why people would meet with us in the first place. You know, what areas do we cover and what areas do we find people are most concerned about? And we go over your main scheme benefits. So very important to know exactly what it is that you're going to be getting from your employer first, before you start looking at options to boost those entitlements up. We also look at the ABC pension scheme. So as I said, Irish Pensions and Finance, we're an ABC provider. For those of you that haven't heard of ABCs before, they're additional voluntary contributions. So they allow you to add or top up or augment your main scheme benefits, okay? And so we'll talk to you a little bit about those and other options that are available to you if you have any concerns around your main scheme benefits. How you can draw down your ABCs in retirement. So, you know, what's the best way, most tax efficient way for you to draw on those benefits, and then how the whole financial process works. So after the meeting today, as I said, you'll be offered to avail of a full financial breakdown, full financial review, and how that works for you. You know, what is the process, what is involved in that. So we go through that later on in the presentation. So look, just very briefly, who we are as a company. Irish Pensions and Finance, we're coming up to our 30th anniversary, okay? So established in 1993. We have a large number of civil and public sector staff on our books, so in excess of 24,000, 3,500 of those have already retired. So we've seen these people through to joining the pension scheme, the ABC pension scheme, working with them throughout their career, and eventually they've retired, and we're working with them now in their retirement. So a very long journey from beginning right through to the very end of our clients that have already retired. So we have 144 schemes in place, so payroll deduction schemes in place throughout the civil and public sector. And the HSE is just one, revenue is one, the county council. So we cover the vast majority of the civil and public pension schemes, okay? Just to give you an idea of, you know, the amount of money that we manage on behalf of our clients, 600 million. So 600 million euros of clients' money is under our management. And one very important thing to note is that we're an authorised advisor. So when we do give you advice, we're not tied to any one particular company. The ABCs are done, the payroll facility is set up through New Ireland Assurance, but any other advice we give you is we're not tied to any particular company. So we have a qualified team in the background here, a qualified team of financial advisors. And very experienced staff. So we have a service centre and retirement help desk. So I know a lot of people, their biggest complaint at the moment is if they ring a large company, everything is automated nowadays. But we're not like that. If you ring through to Irish Pensions and Finance, whether it's our service centre or retirement help desk or through to our offices, you're going to get to speak to somebody straight away. Okay, so we think it's a very good service that we provide, and you know, anybody that's used it speaks very highly of it. So why do people meet with the likes of myself and the advisors in Irish Pensions and Finance? There's a number of reasons, but I suppose the main reasons that we find it stems from a particular concern surrounding the main scheme. Okay, so as you know, you have certain benefits with your employer. And generally speaking, following on from the likes of these talks or an individual consultation, some sort of a concern or need will arise. And that's the main reason somebody, like yourselves, will want to meet with an advisor. Generally speaking, we'll have somebody that might have a shortfall in service. We'll go into more detail about why somebody would have shortfalls in their service. But somebody might be coming up to retirement and they may feel that their pension income is not going to be enough. It's not going to be sufficient. So that might be one reason. Another reason may be that an individual is concerned, God, if I got sick, what would that look like for my family? How would I maintain my mortgage, my rent, my loans? Maybe I'm the higher earner in the family. How would my partner or husband or wife, how would it look for them if I wasn't working? So we look at that for you. We'll talk to you about securing your family's income, God forbid, if you weren't here, so if you were to die in service. And we'll talk to you about the benefits you already have through your employer. And then a big one for a lot of people is savings and investment. So a lot of people throughout COVID have managed to, put away a certain amount of money. And unfortunately, with the way things are going at the moment, savings investments are being, they're being eroded by the rate of inflation. So just to have a look if you're in that situation, to make sure that your savings are not being eroded by inflation, or if indeed you have money investments, are they still fit for purpose? Just given the current climate, we'll have a look at that also for you. So first of all, as I said, in order for you to establish whether your main scheme benefit is going to be enough, first of all, you need to understand what it is that you have, okay? So as I said, the information in this meeting is very general because you're all probably different age groups. You may have all joined at different times. So the first thing is we'll do in the individual consultation, if you decide to avail of that, but in the meeting now, is just to give you a general overview of what you're paying for. So as you can see, when you look at your payslip, you're all paying superannuation pension contribution. So look, what does this entitle you to? So first of all, you're all entitled to an income for life after you've retired. Who pays you that income? When you get paid that income, what that income is going to look like will depend on how much service you have, what scheme that you're a member of, and when you hope to retire. So we'll go through that in a little bit more detail, but you're all entitled to an income for life. You're also entitled to a once-off tax-free lump sum. Okay, so depending on how many years of service you have, and again, depending on your income post-retirement or just before you retire, will depend on what that lump sum looks like. So pension is the income for life, once-off tax-free lump sum, and then your ill health retirement benefit. So God forbid, if you get sick, you're all entitled to a certain period of paid leave before that income stops, okay? So generally speaking, 13 weeks full pay, 13 weeks half pay, followed by the state disability benefit, which is just over 200 euros per week. So for some people, God forbid, if their income was to stop after 26 weeks, this may be a big concern for them. So we'll go through that with you in the individual consultations. What would that look like, and will that pose a concern? As I said, you do have a paid benefit for 26 weeks in place with your employer. Death in service benefit. So if you were to die in service, you also have a lump sum that would be payable to your spouse or your next of kin, and then an income paid to a spouse by means of a portion of the pension that will be paid to a spouse, and a certain portion to any financially dependent children in the event of your death. So for a lot of people that are employed in the civil and public sector, their spouse or their partner, generally speaking, has some element of protection in place through the death in service benefit, their spouses and children's pension. But what we tend to find is that if your spouse or partner is not employed likewise in the civil and public sector, you yourself may be financially exposed if they were to die. because they may not have the same death and service benefits in the private sector or if they're self-employed. So we'll examine that and we'll make sure that you as an individual are protected, God forbid, if your spouse or partner was to pass away. Is that okay? So as I said, look, before we get into you know, the options that are available to you to enhance your benefits, it's important to know what scheme that you're part of. So currently there are 4 pension schemes in the public sector, and it's important to know which one that you're a part of, okay? And depending on when you joined the superannuation pension scheme will depend on what scheme that you're a member of and when your benefits will be paid to you and at what time they're going to be paid. So the first scheme is the original pension scheme that was introduced in the civil and public sector, and this is for people that would have joined before the 6th of April 1995. So if you joined the public sector before the 6th of April 1995, then you're paying the D rate of PRSI, okay? So basically what this means for you is that when you retire, which is any age from 60 onwards, you can claim your pension from your employer, and you can claim it based on your salary and your service from 60 onwards. There's no contributory state pension payable to you because that's just the way the pension scheme, it's just the way the pension scheme is for the pre-1995 entrants. But I suppose the big thing about this is that we would consider this to be the, you know, the Rolls Royce of pension schemes because there is no integration with the state pension. So there's no, I suppose, uncertainty about when the rest of your pension will be paid to you after you're retired, because it's all paid to you from 60 from one source, which is going to be your employer. Okay, so for anyone that joined after 1995, April 95, then what we have is we have the integration of the contributory state pension with the public sector pension scheme. So we'll see later on in a couple of slides how that works and how an individual that joined maybe a day or two after the 6th of April 95, how that's going to impact on their income when they retire, you know, from 60 onwards. So again, anyone that joined after April 1995, they're on the integrated pension scheme, so they do get the contributory state pension, but what their employer will do is they will factor this in to the pension that they're going to pay, and it'll be reduced accordingly. We'll look at the contributory state pension, what age it's payable from in a moment, but bear in mind that there would be an age when the state pension is payable and then the age that you hope to retire. So you may have different ideas about when you hope to retire and when the state pension is going to be payable. So April 2004, another change here that was brought in is that the age at which you can now claim your benefits was pushed out to age 65. So up until April 2004, excuse me, you could claim your benefits from 60 onwards if you joined after April 2004. Now we're looking at 65 from when you can claim your benefits. You can claim your benefits earlier, but it would be on what's called a cost-neutral early retirement basis. So both your pension and lump sum would be reduced accordingly for every year you take your benefits before the age of 65. And then we have the newest pension scheme in the public sector, which is the post-2013 pension scheme, which is different in a number of ways in that post-2013 entrants, there's no set retirement age. So the age in which you can claim your main scheme benefits is directly linked to when you're going to be able to claim the contributory state pension, okay? So that's one thing. And then the other thing is that for post-2013 entrants, you're on what's called a career averaged pension scheme. So your pension is going to be based on what you averaged as an income over your career, rather than your pre-2013 entrants, which is their final salary, which generally speaking, in the majority of cases, is your best salary. Okay. So we're going to look, for illustration purposes, in the examples I'm going to go through for both the pension and the lump sum, we're going to look assuming a salary of 50,000 euros, just for, as I said, for illustration purposes. So in this example here, let's assume that I am retiring today and my salary is 50,000 euros. And I've worked full 40 years in CAMHS. So no job sharing, no career breaks, full 40 years service done. I'm going to retire with the maximum tax-free lump sum that I can have, which is 1.5 times my final salary. So 75,000 euros will be paid to me tax-free on the day I retire. Okay, so let's say my colleague that also worked 40 years in CAMHS, okay, and also on the same salary, 50,000 euros, but my colleague has taken, you know, a bit of time off. She may be reduced, or he may be reduced their working week due to parental leave or unpaid leave or career break. So for whatever reason, they're only going to have, although they were in the service 40 years, but they only accumulated 20 years through various different breaks in service, then obviously they're going to be entitled to half of what I'm entitled when it comes to claiming the tax-free lump sum. Okay, so we'll go through options to bring that up to the equivalent of the full entitlement, but somebody that has less service than the maximum, which is the 40 years of service, is going to have a reduction in their tax-free lump sum. Is that okay? So tax-free lump sum is great, as I said to you, it's a once-off payment paid on the day you retire, but more importantly is the income that you're going to get from when you retire. Tax-free lump sum is a once-off payment, and what we find through our, you know, thousands of clients coming up to retirement now is that's already earmarked, whether it's for home improvements or, you know, future-proofing the energy efficiency of their home or whatever it may be. But a lot of people have earmarked for something. But really what we're looking at here is what's your income going to be? What are you going to end up living on for the rest of your days? So again, for illustration purposes, I'm using 50,000 euros as a salary. So if we look at the first column there, the 25,000 euros per annum, this is an example of somebody that has retired with their full 40 years of service, their pre-1995 entrance, and their income prior to retiring was 50,000 euros. So my colleague there is going to get 25,000 euros as an income paid to them from CAMHS from 60 onwards. Okay, so they can retire from 60 onwards. Salary is 50,000 euros, they full service, so their income drops by 50% the day they retire. Okay, so if I look at anybody here, the next column, which is the third column down here, so if I look at anybody here that retired, excuse me, that joined after the 6th of April 1995, they can retire, as we said, from 60 onwards. If they're pre-2004, 65 onwards. If they're post-2004, their income will be significantly less because they're eligible to claim the contributory state pension. Okay, so their income, their pension income from CAMHS is going to be significantly less, but they're going to be claiming the contributory state pension, unlike the person here getting the 25,000 euros from CAMHS. Is that okay? So in the very last column here, we have the post-2013 entrance, which is the career average pension scheme. So look, unfortunately for the new entrants to post-2013 entrants, because they're a career average pension scheme, it's difficult to calculate exactly what their income is going to be in retirement until we know, one, you know, what their average salary is going to be, and two, what age they're going to be eligible to claim the state pension, because they are deciding factors. So that's something, you know, post-2013 entrants may be concerned about, is the uncertainty around their defined benefit portion of their pension, which is the pension from CAMHS. So the 2013, just to give you a little bit more information, as I said, it's a career average pension scheme. So basically what happens to the 2013 entrants, when they get to retiring, their employer will average what they earned over their career, and that would be divided by their years of service to determine the average income that they had over their career. Okay, when they're entitled to their income, their pension income from their employer, will be dependent on what age the state pension is going to be payable at the time they're due to retire. So look, as we know, a lot of uncertainty around the state pension at the moment. So if you're, you know, quite a bit away from retirement, that may be something that will present a concern for you, and that's something that we can certainly talk to you about and put a plan in place for that. And then, as we said, different factors used for calculation. So it's not your straightforward 1/80th per year of service capped at 40 years of service. Different calculation used for the post-2013 entrance. So again, we will have a look at that and show you what that will look like for you in the individual consultations. So for, what age, look, what age are you going to be entitled to claim your state pension? Well, at the moment, it's 66 years of age, 66 years of age if you're retired now. There was talk about the state pension being payable at 65, being pushed out to 66 for anyone born between 1955 and 1961, and then pushed out to 67 for anyone born after 1961. Look, the answer to that question is, we really don't know where the state pension will go for, people that are maybe 10, 15, 20 years out from retirement. What we do know is that it's payable at 66 now. So any calculation that we give you in the individual consultation will be based on what we know now. And look, if anything changes from one budget to the next, you'll certainly be advised of it. But just to be mindful that the state pension age and entitlement can change, as we've seen in the recent budget. So shortfalls in your superannuation benefits. Okay, so look, what are the main reasons why somebody would have a shortfall? A lot of these are very self-explanatory, and some of these reasons may apply to you and some not. But the main reasons why somebody's going to have shortfall in service is because they either started working late, so they came into the civil public sector late. They want to retire earlier than their normal retirement age. So as we saw in earlier slides, for some of you at 60, some of you at 65, and for others, it's linked to the contributory state pension age. So some of you may not want to work up that far. For some of you, you may have worked abroad. So we see a lot of people, that have done a bit of a stint in the UK, or they've worked in Australia for whatever reason, they've worked abroad, or they've job shared. So they work reduced hours, which is all going to have an impact on your years of service. Some of you may have or may want to take career breaks. You may have non-pensionable unemployment, so that could be in the form of, non-pensionable overtime or allowances, which can all be factored in for boosting your income and your tax-free lump sum. And then unpaid leave, such as parental leave or extended maternity leave. So really, any time, any period that you haven't been paid or won't be paid in the future, whether it's a previous or planned break in service, is all going to have an impact on your service when it comes to calculating your entitlements and your benefits. Okay, so good news is that there are a number of options for those of you that either one are going to have a shortfall in service. Maybe, look, you don't have a shortfall in service, but you're concerned about the integration of the state pension into your main scheme benefits. So we can look at, how can you put a kind of financial safety net in place for that? Or, for whatever reason that the concern arises, there's a number of different options. The first one is that you can buy back temporary or training years. So what this means for you is that if you were employed on a temporary capacity, or if you had a number of years where you were training, you can actually buy them back. And in a lot of circumstances, we would actually recommend that you do this because it's fairly inexpensive, and anything that's going to increase your overall income or service in retirement is worthwhile looking at. So if that applies to you, again, in the individual consultations, we'll talk to you about how you can go and buy those back, and we'll show you what difference that would make to your overall entitlements. You can purchase notional years of service, which is very different to temporary years. So notional years of service, let's say, for example, I want to retire at 65, but I'm only going to have 35 years of service. I can go to my employer and I can buy back 5 years of service to give me my full service at retirement. From past experience, people that have looked into this have found it prohibitively expensive, but it may be an option that is worthwhile for you to look at. And again, we can talk you through that option for you, show you the difference that it would make in retirement. And then you can go get a quote from your employer and see if it's something that financially that you're eligible to do or able to do, more so should I say. Then there's ABCs, okay, so the ABC, as I said, it's the service that we provide into the civil and public sector by way of payroll deduction. So an ABC, first of all, you do not have to do an ABC, but it's a voluntary contribution that you yourself can make if you have a concern in relation to your lump sum, your pension, or both. Okay, so you can add to your main scheme benefits. You yourself can decide how much you want to put in. You can, it's done through your payroll department, so it's a relatively easy way of boosting the lump sum, the pension, making up the difference between when you hope to retire on the state pension or all three. Really up to yourself. We look at the ABCs in a little bit more detail now in a moment. And then option 4 is to do nothing. And doing nothing sometimes is the best course of action. So again, any recommendation that we make to you in the individual consultations, we'll look at everything. We look at all of your finances, we'll take into account your spouse or your partner, and we'll see if buying years of service, ABCs, or doing nothing is the best course of action for you, okay? So the ABCs, just to give you a bit of an indication of how they work, as I said already, they're done through your payroll department. Tax relief is done at source. Tax relief is a huge, I suppose, not only an incentive, but it's one of the biggest reasons why people, bar being short service, it's one of the biggest reasons why people do ABCs is the tax incentive. So we look at that in the next slide. ABCs can be done on a regular basis. So what the majority of people will do is they'll set up a regular contribution from their pay slip. They pay into it either weekly, fortnightly, or monthly, whichever way they're paid. And they have, the reason why they feel this is the best option for them is they have more control over being able to increase it if they have the capacity, and likewise to decrease it if needs be. Lump sums, we find at this time of the year especially, a lot of people like to put a lump sum into their ABCs for unused allowances for the previous tax year, and they can get tax relief on that. A number of reasons being, look, maybe they have rental income and they want to offset some tax liability there. And they may want to backdate pension contributions for a previous year, unused pension contributions. So you can do that also, and it's something that we can talk about if that's something that you want to do for 2021. ABCs are invested, so it's important to know where your ABC is invested between now and your retirement date, and the level of risks that you're happy to take. For some people, if you're very close to retirement and you're only doing what we call a last minute ABC just to make up the shortfall in your tax-free lump sum a couple of weeks or months out from retirement, the ABCs won't be invested, they'll just be put into a holding fund. But for the majority of people, the ABCs are invested. So as I said, it's to know where they are invested. And there's charges that are associated with ABCs. So ABCs, as I said, are done through your payroll department. So there are charges for the service for that. There's charges for air services through ongoing yearly financial reviews and management of your ABCs. So we'll talk you through that before you decide whether an ABC is for you or not, okay? As I said, the tax relief on ABCs is probably one of the most, attractive and efficient ways to save. So for somebody on the lower rate of tax relief, ABCs represent a 25% increase on what you're saving, okay? So in other words, if I was putting in 100 euros into an ABC, revenue would be topping me up by 25 euros on my 100 if I'm on the lower rate of tax, which is, is still excellent return on an investment. But if you're on the higher rate of tax, the only good news about being on the higher rate of tax is that your incentive is actually 67 euros. So 67 euros, if you put in 100 euros from your take-home pay, you're actually saving 167. So really tax efficient way of saving towards your retirement. So it's, if you think of it like deferred savings, please God, eventually you will get to spend this money at some stage, but the tax relief is one of the most, I suppose, attractive ways of saving for your retirement, okay? So let's take a quick look at how you can build up a relatively large sum of money over a relatively short period of time. So in this example, we're looking at somebody that's, committed to putting away 70 euros per week from their take-home pay over a 16-year period. Now, obviously, it's not as straightforward as this because the majority of people will increase their ABCs over time as their salary increases, as they get pay awards, promotions, etc. But this is just for illustration purposes. So we had somebody over a 16-year period that would have saved just under 58,500 euros. But because they've done this in an ABC, so a revenue approved way of saving, they've actually added an additional just under 39,000 euros to their savings just through tax relief alone. Small little bit of growth, and so the estimated growth is just 3%, so just over 2,500 euros. So if we just factor in, a small amount of growth, their savings of 70 euros per week, they're up to 100,000 euros, costing them just 58,500 over 16 years. So I suppose it's important to note that ABCs are not going to be advisable for everybody and are not going to suit everybody, but certainly for those people that they do suit, very, very good tax incentives there for saving for your retirement. So let's assume that you've built up your ABCs and now you're retiring. You want to know, look, what is the best way for me to draw these ABCs down? The first thing that you'll do, if we can kind of think back to our previous slides when I was showing you the tax-free lump sum, we had somebody in full service getting 75,000 euros tax-free and their colleague with only half service just getting 37.5. Well, the colleague getting 37.5 can bump their tax-free lump sum up to the maximum allowable, which was the 75 in the previous illustration. So they can take out 75,000 euros tax-free. And then the options with the remaining ABC is to purchase an annuity, which is basically an income for life. So if they wanted to buy an income for life, they can use their 75,000 euros, assuming that's the balance, 75,000 euros, we just assume for illustration purposes. They can use that to purchase an annuity, which will be paid to them for life. Okay, so obviously it's for the life of the individual. If they were to die, the income dies with them. So may suit some people, may not suit other people. They can purchase what's called an approved retirement fund, which basically means that the ABC rolls over into this approved retirement fund, which remains invested for them into retirement. So you still have the potential to grow your fund in retirement. You can draw anywhere between 4% and 15% of the fund in the first 5 years. I suppose the big reasons why the majority of people go down the route of the ARF is for the potential for growth in retirement. And then in the event that they were to die in retirement, that the fund passes to an next of kin. Okay. If you decide that you want your money paid back to you as a taxable lump sum after saving in retirement, you can take it all back as a taxable lump sum. It's obviously not advisable. It's not the most tax efficient way. It's not a tax efficient way, should I say, of taking the money back. But if you need the money back, it can be paid back to you in a taxable lump sum. So, just before I finish up, I just want to explain to you how the process works after the talk now. So before today's webinar, I sent you all a link to a pre-appointment questionnaire, and this is for you to get an individual breakdown of your main scheme benefits and to have a much more tailored view of what your income is going to look like in retirement. Now, for some of you after the talk today, you may say, well, look, the pension doesn't really concern me. I'd be more concerned about if I got sick, how do I pay my mortgage? How do I pay my rent? Or I'd be more concerned about if I die in service or if my spouse dies. If my spouse dies, what would my income look like for me and my family? So there's a number of different areas of concern. And in that pre-appointment questionnaire I sent you, you can click the various different areas that you want to discuss. There may be one or there may be a number of areas. So what we'll do is we'll establish your goals and objectives. We'll stress test them, so we'll show you what you already have in place, and you can let us know if you feel that that's enough or if that you need to change them in any way. We'll make recommendations to you the options that are available to you, whether it's pension or salary protection or additional life cover. And then if you do decide that you want to make any changes, everything is done. It's a digital application process, so everything can be done online. Whatever policy you do decide to take out, whether it's an ABC or whether it's salary protection or life assurance or whatever it may be, we review things annually. So it's not like as though you decide to do something today and we come back to you when you're 65 or 6 months out from retirement. It's reviewed annually to make sure that whatever goals that you set for yourself, that we're looking at them on an annual basis if your circumstances do change. So just very briefly, we have a mortgages department as well for anybody that's maybe looking at a new mortgage or maybe considering locking in their mortgages, just taking interest rates into account, the various different increases in interest rates coming down the line. So the web address there is ipf.ie/mortgages if you'd like to speak to our mortgage advisor. And just for those of you, as I said, the pre-appointment questionnaire that went out to you earlier. So the main areas of concern here listed on the bottom, you can just tick the areas that you want to address. And either myself or my colleague, Kira, who's on the talk today, either myself or Kira will be able to follow up with you to have a discussion with you just to see if a full review is required or if we can, in what way we can help you.